The American government owes $38 trillion. That's not a typo. 38 trillion with AT. And here's the uncomfortable part nobody wants to say out loud. They're never paying it back. Not in the way you think, anyway. Instead, Washington is executing the most sophisticated financial sleight of hand in modern history, using gold reserves that have been deliberately undervalued for 50 years and a cryptocurrency stockpile most people don't even know exists. This isn't a conspiracy theory. This is monetary policy disguised as bookkeeping. Let's start with a number that should terrify you. Right now, the United States national debt is growing by $71,000 per second. Not per hour, per second. By the time you finish this sentence, another $300,000 just got added to the tab. Interest payments alone have tripled in the last 5 years, and they now consume more federal spending than the entire defense budget. We've crossed a threshold. That historically only happens during existential wars, and we did it during peacetime. The debt to GDP ratio sits at 123%, a level last seen when we were fighting Nazi Germany and Imperial Japan simultaneously. Welcome to Finance Historian. Here we break down global finance. Just a quick reminder, before we get started, smash the like button and subscribe if you love financial deep dives. Comment your city and the time you're watching this. I want to see how global this community is. Here's what makes this different from every other debt crisis. The US isn't Argentina. It's not Greece. It controls the world's reserve currency, owns the largest gold reserves on the planet, and just happens to be sitting on a cryptocurrency fortune worth potentially hundreds of billions. Most importantly, it has tools that no other deterrent nation possesses. The question isn't whether America can escape this debt trap. The question is how they're doing it right now. While economists argue about interest rates and politicians pretend tax cuts will fix structural insolvency, think about how normal people handle debt. You borrow money, you pay it back with interest, and if you can't, you lose your house. Governments don't work that way. Governments have a cheat code called monetary sovereignty. And the United States has been playing this game longer and better than anyone else. What's happening now isn't default. It's something far more elegant and far more ruthless. There's a vault in Kentucky called Fort Knox. You've heard of it. What you probably don't know is that the gold sitting inside that vault, all 8,133 tons of it, is valued on government books at $42 per ounce, not $4,000, which is roughly where gold trades today, of $42. That valuation was set in 1973, and it has never been updated. This isn't an oversight. This is deliberate. The United States holds 261 million troy ounces of gold, making it the largest sovereign holder in the world. At current market prices hovering around $3,000 to $4,000 per ounce, that stash is worth somewhere between $773 billion and over $1 trillion. But on the Treasury's balance sheet, it's listed at just $11 billion. That gap, that difference between what the gold is actually worth and what the government claims it's worth, represents the single largest hidden asset in the federal government's arsenal. JP Morgan projects gold will hit $5,000 per ounce by late 2026 and climb toward $5,400 by the end of 2027. If that happens, and there is no reason to think it won't given current monetary instability, the U.S. gold reserves could be revalued to generate over $1 trillion in liquidity without Congress passing a single new tax, without the Federal Reserve printing a single new dollar, and without adding 1 cent to the national debt. You're probably thinking, this sounds too easy. If the solution is just updating the price of gold on a spreadsheet, why hasn't it been done already? Because revaluation isn't politically neutral. It's a nuclear option that changes everything about how global finance operates. When you revalue gold, you're admitting the dollar has been debased. You're telling bond holders their treasury holdings are worth less in real terms. You're signaling to the world that the rules are about to change. But here's the thing, the rules are already changing. The dollar just posted its worst 6-month performance since 1973, dropping 11% against a basket of major currencies. Morgan Stanley estimates it could lose another 10% by the end of 2026. That's not a correction. That's a structural shift. And when your currency is weakening anyway, revaluing gold stops looking radical and starts looking like basic asset management. This has been done before. In 1933, Franklin Roosevelt faced a banking system in total collapse. He issued Executive Order 6102, which banned private gold ownership and forced citizens to surrender their gold to the Treasury at $20.67 per ounce. Then months later, the government revalued that exact same gold to $35 per ounce. Overnight, the dollar was devalued by 70%. The Treasury's balance sheet was fortified and the economy had the liquidity it needed to escape the depression. It was brutal, it was controversial, and it worked. The mechanics of modern revaluation would be cleaner, but no less powerful. The Treasury would issue gold certificates to the Federal Reserve acknowledging the difference between the official $42 valuation and current market value. The Fed provides funds equal to that difference. The Treasury now has hundreds of billions in cash that didn't exist before. Critically, this isn't a loan. It doesn't expand the debt. It's an accounting adjustment that reflects reality. Some estimates get truly aggressive. If gold were revalued to $72,000 per ounce, the U.S. could theoretically wipe out half its national debt. At $144,000 per ounce, the entire $38 trillion could vanish. Those numbers sound absurd until you realize that gold has already risen from $200 in the early 2000s to over $4,000 today, a 20-fold increase. Asking if it could go another 4 or 5-fold higher isn't crazy. It's extrapolation. But gold is old world money. It's what central banks trusted when they still wore top hats. What's genuinely unprecedented is what's happening with the new money. The digital stuff governments claimed didn't exist until they suddenly realized they owned more of it than anyone else. In March 2025, President Trump signed an executive order creating the Strategic Bitcoin Reserve. Not a proposal, an actual operational reserve capitalized with Bitcoin seized from criminal proceedings. Silk Road busts, ransomware takedowns, fraud cases. Every Bitcoin the Justice Department ever confiscated now sits in government wallets instead of being auctioned off. Current estimates put U.S. government holding somewhere between 3,005,000 and 328,000 Bitcoin, making it the largest sovereign holder on Earth. At today's prices, that's worth tens of billions. If Bitcoin continues its long-term trajectory, that number stops being tens of billions and starts looking like hundreds of billions or more. And here's the part that should make you pay attention. The reserve isn't limited to Bitcoin anymore. The administration expanded it to include Ethereum, Solana, Cardano, and Ripple. The United States government is building a multi-asset cryptocurrency treasury, and it's doing so not by buying these assets, but by simply refusing to sell what it already owns. This represents a complete philosophical reversal. For years, seized crypto is treated like seized cars sold at auction to recover value. And now it's being treated like strategic petroleum reserves or gold held indefinitely as a national asset. States are following the federal playbook. Texas bought $5 million worth of Bitcoin ETFs. Other states are drafting legislation to create their own reserves. This isn't fringe anymore. This is policy. The logic is straightforward. Bitcoin has a hard cap of 21 million coins. If it can't be printed, can't be inflated, and has never been hacked at the protocol level. As governments worldwide continue expanding money supplies, Bitcoin scarcity becomes more valuable. If the US holds a significant percentage of total supply and the price appreciates even modestly over the next decade, the reserve becomes a genuine fiscal asset capable of offsetting debt. Skeptics will point out that crypto is volatile, that it's speculative, that no serious economist endorses this strategy, and they're right on the first 2 points. But here's what they're missing. The government doesn't need economists to approve something that's already operational. The reserve exists. It's holding assets, and those assets are appreciating. That's not theory. That's accounting reality. What matters isn't whether traditional economists endorse the strategy. What matters is whether the assets gain value faster than the debt grows. And here's where the numbers get uncomfortable for anyone hoping this stays theoretical. The debt is currently growing at $71,000 per second. That's not a typo. Every single second, the national debt expands by more than most people earn in a year. At that pace, we'll hit $39 trillion by April. Another trillion added in roughly 5 months. Meanwhile, interest payments have become the fastest growing federal expense. They've nearly tripled in 5 years. By 2028, the Congressional Budget Office projects that interest alone will consume nearly 15% of all government spending. That's more than we spend on defense, more than education, more than infrastructure. We're paying interest on money we borrowed to pay interest on money we borrowed before that. This is the debt spiral everyone warned about, and it's happening right now. So when you see headlines about crypto reserves or gold revaluation, don't dismiss them as gimmicks. Understand them as emergency exits from a burning building. The U.S. government is cornered. Traditional solutions, raising taxes, cutting spending, economic growth, none of them move fast enough to outrun compounding interest at this scale. Which brings us to the mechanism nobody wants to discuss openly, but everyone understands is already in motion. Inflation. Milton Friedman called it the only form of taxation that requires no legislation. He was right. And the government has been deploying it aggressively since company. During the pandemic, the federal government spent roughly $5 trillion. Where did that money come from? 97% came from debt and money creation, not taxes. The Treasury issued bonds. The Federal Reserve bought those bonds with newly created money. That money flooded into the economy. Prices rose. Your savings lost purchasing power. The debt burden shrank in real terms. This isn't conspiracy. It's documented policy. The Fed's balance sheet exploded from under $4 trillion before CO to nearly $9 trillion at its peak. That's $5 trillion materialized from nothing used to finance government spending. The cost was transferred directly to anyone holding dollars. Here's how the math works. If inflation runs at just 2% annually, the government confiscates half your wealth in 36 years. At 4%, they take half in 18 years. Every percentage point of inflation reduces the real value of the $38 trillion debt pile by hundreds of billions. For you, inflation is a crisis. For the government, it's a solution, and it's accelerating. The dollar lost 11% of its value in the first half of 2025. That's the largest 6-month decline in over 50 years. Morgan Stanley projects another 10% drop by the end of 2026. We're watching a $15 bull cycle collapse in real time. Multiple forces are converging. The Fed is cutting interest rates aggressively from over 5% toward 2.5% by next year. That narrows the gap between U.S. rates and the rest of the world, removing one of the primary reasons foreign investors hold dollars. Tariffs are creating trade friction. Political uncertainty is shaking confidence. The result is a currency in freefall. Now connect the dots. A weaker dollar makes American exports more competitive. It reduces the real value of dollar-denominated debt. Foreign creditors holding treasury bonds lose value in their home currencies, while the U.S. government repays obligations with depreciated currency. This isn't accidental. This is strategy disguised as chaos. Some analysts are starting to say it out loud. The unpredictability of the current administration may be intentional. Create enough policy chaos that markets can't price risk accurately. Pick fights with the Federal Reserve. Threaten to fire the chairman. Deploy the highest tariffs in decades during the longest government shutdown in history. The result is a controlled demolition of dollar dominance that looks like incompetence from the outside, but functions as debt relief from the inside. You might be thinking, this sounds insane. And you'd be right. It is insane. But so is $38 trillion in debt growing at $71,000 per second with no politically viable path to fiscal balance. Desperate governments do desperate things. And the playbook they're running isn't new. It's just been updated for the 21st century. Roosevelt did this in 1933. He banned private gold ownership through Executive Order 6102, forcing citizens to surrender gold at $20 per ounce. Then he immediately revalued that gold to $35 per ounce, a 70% devaluation of the dollar overnight. The government inflated away debt while citizens watched their purchasing power evaporate. The difference today is they don't need to confiscate anything. They just need to hold assets that appreciate faster than the currency depreciates. Gold at $4,000 per ounce while it's officially valued at $42. Bitcoin at $60,000 with a fixed supply cap, while dollars multiply infinitely. The mechanics are different, but the outcome is identical. Wealth transfers from savers to debtors. And there's no bigger debtor than the United States government. Now layer in one more mechanism that almost nobody discusses: debt monetization. This is when the central bank buys government debt directly, creating new money to finance spending. It's technically illegal in many countries because it's considered too dangerous. But the Fed has been doing it for years through quantitative easing programs, just under a different name. During CO, Bloomberg estimated the Fed would buy $3.5 trillion of government debt. That's not the government borrowing from investors. That's the government printing money to buy its own debt. The line between fiscal and monetary policy collapsed entirely. The critical question is, what happens to that newly created money? If banks lend it out, it multiplies through the financial system, creating inflation. If they hold it as reserves, it stays contained. During the 1970s, banks lent aggressively. Inflation exploded. Recently, banks held reserves because they could earn interest from the Fed itself. Inflation stayed manageable until it didn't. But here's what's shifting. As the Fed cuts rates and reduces the interest paid on reserves, banks lose the incentive to hold cash. They'll start lending again. That money will flow into the economy. Prices will rise, and the debt burden will shrink in real terms while your paycheck buys less. This is the hidden mechanism behind everything. Gold revaluation provides a one-time accounting boost. The crypto reserve builds long-term strategic value. But inflation does the continuous heavy lifting, eroding debt day after day without requiring congressional approval or public acknowledgement. It's the perfect crime, visible to everyone yet deniable by officials. You feel poorer, the government's balance sheet improves, and nobody voted for it. So what does this actually look like in practice? Let's map out the full convergence. Step 1. The Treasury revalues gold from $42 per ounce to current market prices around $4,000. That generates roughly $773 billion in accounting gains, not borrowed, not printed in the traditional sense, just recognized value that already exists. Step 2. The Strategic Bitcoin Reserve holds approximately 325,000 Bitcoins seized from criminal operations. At current prices near $60,000 per coin, that's roughly $19.5 billion. But here's the leverage point. Bitcoin's fixed supply cap of 21 million coins combined with growing institutional adoption creates asymmetric upside. If Bitcoin reaches 200,000 per coin over the next decade, which some analysts project, that reserve balloons to 65 billion. At 500,000 per coin, it's over 160 billion. Step 3. Inflation runs at 4 to 5% annually instead of the Federal Reserve's stated 2% target. This isn't announced. It just happens through supply chain disruptions, energy policy, fiscal spending, and monetary expansion. Over 10 years at 4% inflation, the real value of $38 trillion in debt eroded by roughly $13 trillion without paying back a single dollar. Now add those mechanisms together. $773 billion from gold, potentially $100 billion plus from crypto appreciation, $13 trillion from inflation erosion. You're looking at debt reduction of $14 trillion over a decade without raising taxes, cutting programs, or defaulting on obligations. That's not theory, that's math. But there's a catch most people miss. This only works if other countries don't do it first or don't retaliate. The moment China revalues its gold reserves or launches its own crypto reserve or deliberately crashes the dollar through coordinated selling, the game changes entirely. Financial warfare operates on speed and positioning. The first mover gains advantage. The second mover faces consequences. And that's exactly what's happening beneath the headlines. Countries are quietly diversifying away from dollar-denominated assets. Central banks are buying gold at the fastest pace in decades. Nations are exploring central bank digital currencies specifically designed to bypass dollar settlement systems. The global monetary order is fracturing in real time. The United States isn't erasing debt in isolation. It's front-running the collapse of the post-World War II financial architecture it created. Now let's address the elephant stomping through the room. What happens to you? If gold gets revalued and Bitcoin appreciates, your savings don't participate unless you personally hold those assets. Most Americans hold dollars in checking accounts, retirement funds invested in stocks and bonds, or real estate. When inflation runs hot and the dollar depreciates, those assets either lose purchasing power or struggle to keep pace. The government's debt burden shrinks. Your cost of living increases. Groceries cost more. Rent rises. Healthcare gets expensive, and your wage probably doesn't adjust fast enough because labor markets lag behind asset price inflation. This is the wealth transfer in action. Debtors benefit, savers suffer. And the largest debtor on planet Earth is the entity managing the currency you are forced to save in. You might be thinking, can't I just buy gold and Bitcoin myself? Yes, but here's the cruel irony. When the government holds gold valued at $42 per ounce and you buy it at $4,000, who profits from the revaluation? They do. When the government accumulates Bitcoin through seizures at near zero cost and you buy it at $60,000, who captures the upside from here? You bear the risk. They hold the asymmetric position. The game is rigged structurally, not through conspiracy, through timing and access. There's another layer that almost nobody discusses. What happens to global trust in U.S. assets when this becomes obvious? Treasury bonds are considered the safest investment on Earth because they're backed by the full faith and credit of the United States government. But if that government is actively engineering currency depreciation to erode debt, why would foreign creditors keep buying bonds that guarantee losses in real terms? They wouldn't, and they aren't. Foreign holdings of U.S. treasuries have plateaued. China has been reducing its position for years. Japan remains a large holder, but faces its own fiscal crisis. Middle Eastern oil producers are diversifying into other currencies and assets. The buyer base for U.S. debt is shrinking precisely when the government needs to issue more. This creates a doom loop. More debt requires more buyers. Fewer buyers mean higher interest rates to attract capital. Higher rates increase debt servicing costs. Increased costs require more borrowing. And the cycle accelerates until something breaks. The Federal Reserve steps in as buyer of last resort through quantitative easing. But that's just monetization with better branding. The central bank creates money to buy government debt that private markets won't touch at reasonable rates. And that newly created money eventually flows into the economy as inflation. We've seen this script before, where Germany, Zimbabwe, Argentina, Venezuela. The specifics differ, but the pattern is identical. Governments with unsustainable debts resort to monetary expansion. Currency collapses, savings evaporate, and societies fracture. The United States has advantages those countries lacked. The dollar remains the global reserve currency. The U.S. military projects unmatched power. American financial markets are the deepest and most liquid in the world. These factors buy time. But time is not unlimited. Every empire in history believed it was different until it wasn't. Rome debased its currency through coin clipping. Spain inflated through New World gold imports. Britain exhausted itself, financing 2 world wars. The mechanisms change, the outcome repeats. So where does this end? The answer depends on whether you believe governments learn from history or are condemned to repeat it. What's certain is this: the $38 trillion debt is not disappearing through austerity or economic growth. It's being dissolved through asset or revaluation, currency depreciation, and inflation. The tools are already deployed. The mechanisms are already running. And the cost is being quietly transferred to anyone holding dollars while the government holds gold and Bitcoin. You're watching the largest financial restructuring in modern history unfold in real time.